Hi, everybody. Thanks for joining our call. We really appreciate you taking the time to join in with us. As you might recall, our most recent one of these phone calls was back in February. At that point, the stock market was quite depressed, and the fall in the price of oil was dominating headlines as either the canary in the coal mine warning of economic collapse or something that would cause that collapse by itself. As it turned out, the timing of that phone call almost perfectly coincided with the lows in nearly all the markets. Quite a few months, 5 months later, and 5 straight months of gains for the U.S. stock market. I'm choosing to ignore just the very small decline that's happened over the past week. As for oil, it surged during the spring, entered a bull market, and is now back in a bear market as the price has fallen 20% in recent weeks. But still, it's well above its February levels. So, has anything else of note happened over these past few months? Oh yes, the UK voted to leave. About a week that seemed like an apocalyptic moment for investors. And then markets shrugged, and actually did more than shrug, they leapt higher than they'd been before Brexit, as a matter of fact, including, by the way, Britain's own stock market, although the pound has been severely punished. And anything else going on? Oh yes, the American election is less than 100 days away. Both parties have adopted their platforms, and many of the talking points and proposals have been established. And based on those, it would not appear that things are looking very good for investors. Both parties are staking out positions against expansion of trade. And in fact, Trump at times seems to want to cut off contact with most of the world. Both parties claim they want to break up the banks. And as we saw in Britain and throughout the American primaries, voters seem to have a propensity these days to lean towards radical, unpredictable policies rather than work within existing frameworks. Now, I could go on, but why depress us all further? So the question I'm asking myself is why would investors be so blasé, even more than blasé, downright optimistic, as we just noted with the markets going up so strongly these past few months, downright optimistic with this political and international framework? Well, there are positives, and I do think it's good that we keep reminding ourselves of them. In the U.S., we have low inflation, we have low unemployment, economic growth that showed a lot of resilience. Europe's actually been recovering fairly well in 2016, although Brexit does throw this into doubt. And the truth is, actually, that the UK economy has been expanding rather nicely through this year, and much of continental Europe has also been doing well. China has been mentioned often as a menacing risk factor to the global economy with a crash imminent. But in fact, it's held together rather nicely to date. So those are all the facts on the ground, if you will. But as we know, the markets mostly look forwards, not backwards, and honestly, not even at present conditions. So what about the future? One thing that does seem fairly certain is that central banks will continue to do what's in their power to propel economic growth. Whatever the actual results of all of these efforts have been, and they are debatable, what has mattered more is that investors view the efforts favorably, and they have supported stock prices. Another thing that could be pushing prices higher now, and admittedly this is more speculative on my part, is that more help for economies is on the way, whether because there's increased skepticism about the effectiveness of the monetary stimulus or just because. It seems likely that whichever way the elections go, there will be some combination of tax cuts, maybe more likely with Republicans, or increased spending, more likely with Democrats, that will provide the economy with more impetus. In addition, I do expect Europe to loosen the reins and cut back on their austerity, and you might all have seen that Japan just approved a large pump priming measure. So again, whether all of this, one, comes to fruition, or two, is effective even if it does occur, what I think is most relevant is that investors believe in it. And this could help explain what we've been seeing these past few months. So with that, I'd love to hear your questions or thoughts. Thank you. Nationwide index of housing prices. Things are back to where they were in 2006. That's good news, I guess. It's a long time coming. Definitely not in the Washington area. Prices are still actually a little bit below where they were, although again everything is local. But just as we think about, well, where are we going forward? I guess there's plenty of reasons to be optimistic, along with the normal doses of caution. We have lovely low mortgage rates that do not seem likely to rise very much. And from a seller's standpoint, the positive would be that there's a pretty low inventory, so there's a pretty good supply-demand mix right now from the seller's side. And there's been appreciation of about 6%, I guess, over the recent years, and that's relatively sound, and that's probably what someone would expect going forward with not very much inventory coming onto the market. So I hope I answered that question okay.
Yes, that was helpful. I want to, Nate, it's Nancy. I want to ask about bonds. Could you explain to us what is the factor that propels bond yields up nowadays, and which kinds of bonds do best or not, and why?
Sure, Nancy, and I just wanted to go back and just kind of elaborate on your question a little bit, and I think one of the things that's happened is the yields have gone down, which means like the prices have gone up, which is in general a very good thing, and it's kind of been contrary to what a lot of predictions have been over the past few years, that bond prices were so expensive that there was only one direction to go, which was down for bond prices. But in actuality, they've done extremely well, actually better than stocks this year. And it is a little bit of a head scratcher as to why, but really I guess the major reason is that there is absolutely no inflation throughout the world. That's good to keep interest rates low and bond prices high. And in addition to that, the fact that there's really nothing threatening bonds right now, in addition to that, really what all these actions of the Fed and the European Central Bank and all the others really is to actually manipulate the market and to keep the interest rates low and the bond prices higher than they would be otherwise. So it's actually, there's a lot of direct government intervention in the bond market that's pushed prices very high, and not just on their own government bonds, which are extremely expensive, and I can give an example of that in a second, but that's even kind of bled into the corporate bonds, and almost every stripe of bond has been a stellar performer this year. I said, but mostly for those two reasons: the government manipulation and just the actual economic fact that inflation is so low. I just wanted to give an example of how absurdly, I guess I shouldn't say the word absurd, but I just did, expensive or the bond prices are, which is again another way of saying how low the yields are. So basically Germany, the nation of Germany went out to borrow money for a 10-year bond similar to what we do here, and the rate of interest was negative. So people were buying those bonds with 100% guarantee that they would lose money in 10 years. So that is, here comes that word again, that is sort of the absurdity of the situation that we're in right now with bonds. But that is one way of demonstrating how expensive they are and really how their value has gone up as the interest rates have gone down. And again, just that notion that investors are buying bonds for a fairly long term with a guaranteed loss. It just kind of shows how distorted and in some ways illogical some of the investment activity is right now.
So can you comment on short-term versus long-term, or what's long-term?
I guess the conventional definition of long-term is greater than 10 years. And if you just think about, well, what do we have here as Americans if we wanted to buy our treasury bonds? If you wanted to loan the government money for 10 years, you would get 1.5% guaranteed. And if inflation is 0 or negative, you know, it's turned into a good investment. If inflation is 4 or 5%, it was terrible. And we'll just have to see. Right now, you know, I don't think people have a very long range of vision, but definitely right now, as we sit here in 2016, the conventional wisdom is that we're not really facing inflation just because of all the technological advances and things like that are lowering the cost of everything. So that's, and you know, the short-term bonds are worse. Again, at least you don't have you're not loaning the money for 10 years. Maybe you're only loaning it for 3 months or with a CD or 1 year. But basically, you will receive, you know, 0 to 0.5%, something like that. Which is definitely less risky, but on the other hand, it's been these long-term bonds that have just been making a ton of money as the interest rates have dropped so much. But that's kind of the situation that really fixed income investors are facing now, is that because of some of whether again because of the inflation predictions or just how the government is pushing down the interest rates, is that it's really not looking very promising for people that want to invest a lot of their money into bonds and to try to support their retirement through interest.
But if all you want is for the value to go up, then it's okay.
Yeah, at least not to drop, right. So at least if you know that you want to give them $100 and to get back $101 next year, yeah, that's fine. Sure, it's fine. I mean, again, I know, again, one of the presidential candidates, Donald Trump, has talked about defaulting on debt as a strategy, but I think he did change his mind pretty quickly on that. So again, if you looked around the world as a safe vehicle to invest in, bonds would still be considered the safest.
Nate, hi, this is Doug.
Hi, Doug.
Hey, I wonder if moving from bonds to equities, you could comment a little bit on how you see the international markets in 2 respects. Number one, how you see Europe versus Asia versus emerging markets. That's number one. And number two, in terms of allocating assets, whether you see anything on the horizon that suggests that allocations to international stocks and bonds should be less or more than they currently are within the portfolios you manage in the year or two ahead.
Okay, well, great question, and definitely, as I'm sure you know, I think about this a lot. I wish I had the perfect answer. I would say in general we have not increased or decreased, the allocation to international, which is sort of meant that we've had to put some more money into international over the recent years because it has done relatively poorly, partly because of what's happening overseas, partly because the dollar has been very strong. I would say as we think about, Europe in particular, I guess I suppose there is some reason to be optimistic about it, and it's kind of sound contrarian, but the reason, I guess, as investors to be sort of optimistic about it is that, by and large, no one else is. The world is not optimistic about Europe at all, and it's very easy to see all the problems and things like that, all the things that they're wrestling with. And from an investor standpoint, that looking forward, that's not a bad thing, because when everyone is pessimistic about a certain area, whether it's Europe or anything else, that usually means that that's a relatively attractive place to buy. Now, that's no guarantee. Things could continue to spiral downhill. They could, by pushing the negative interest rates, they continue to hurt all their banks. They could not adopt reforms after Brexit and all of that. But honestly, I think there are legitimate reasons to be optimistic about Europe, and that they would make some more fundamental changes rather than beyond what they've already done, just to respond to what's happening politically. The emerging markets, and this is actually an example of what's kind of already happened. You know, I don't think, if you're reading in the paper today how miserable Brazil is, how miserable Russia is, some of the other emerging markets, and the actual fact is that those, from an investor standpoint, have been the best places to invest this year. So it kind of works that way, where people are so pessimistic about a place, as they were with Brazil before they replaced their president, some of the other countries around the world, that, you know, sometimes the prices just get too low. And I think that does happen. And then when there's any kind of turnaround, whether it was with Brazil making the political change, with Russia, the price of oil going up, with Asia, just the recognition that, oh, China's not collapsing, it's doing okay, and India, you know, making their kind of reforms, that the prices can actually go up pretty substantially. And as I say, some of these emerging markets have been, you know, pretty good this year. And they're, you know, a lot of the times with the markets and with investing, it's more sentiment driven than actually what's happening on the ground. And that's kind of what's happened this year. And I would still say that when you look at most of the international areas, whether it's Japan, Western Europe, around China, that I would describe the mood as pretty pessimistic. And again, from an investor standpoint, sitting here in early August, that's not a reason to despair. It's a reason to say, oh, well, that's okay. So this, when everyone else is pessimistic, that's a decent place to be invested in. And that's kind of been our approach to it.
Good, thank you.
But again, you know, oh, thanks, Doug. It was a great question.
Nate, I wonder if I could ask another question that is Nancy about, that's related to the elections, or after the elections are over. And this is a hypothetical, but if you could tell us how it works. Suppose it happened in 2017 that the Congress passed a law to lower corporate tax, let's say, from 35 to, say, 18%. Let's say we had a much lower corporate tax. What would happen then to the U.S. market for equities, and maybe, you know, foreign market, international?
Mm-hmm. Well, if I had to guess, I would just say that the markets would view that as a huge positive, because the market doesn't care about, well, what's the budget situation in 10 years. You know, they would just say, well, are we making the atmosphere more positive for business? Absolutely. Would some of this money that Apple and a bunch of other companies have parked overseas because they don't want to bring it back because of the taxes, they would bring it back. That would be a good one-time boost, actually, to the coffers of the Treasury, because they would pay the taxes at that lower rate that they're just going to not pay now. So that would probably be a good thing. You know, honestly, probably what would be the best thing for the global economy is if just everybody got together and they all charged the same rate, so
Yeah,
that the companies
that's what I was
wouldn't
going to
bounce
ask.
around.
Yeah.
Yeah.
If everybody
So I
were
think,
15 or 18. Yeah.
yeah, or maybe in the 20s,
Or
showing
maybe.
my colors here a little. Yeah, most countries are in the 20s, and that would probably just, you know, would level the playing field and stop having some of this stuff where, you know, Pfizer goes and changes their headquarters to Ireland or England to lower their taxes, and some of these other things that have gone on that really they don't have any kind of economic benefit at all. So that would be a good thing, and that's been one thing that even in 2013, 2014, some people were trying to get to happen, but they haven't been able to put it all together yet. And maybe, you know, optimistically in 2017 that could be part of an overall tax package that might make sense.
Mm-hmm. Mm-hmm.
So that would be a great thing if that happened.
Nate, this is George.
Hi. Hey, George.
How are you doing?
Good, yourself?
Oh, pretty good. Other than asking if you could sometimes hold this in the morning, it's fine. I was wondering, since I see things, you know, 7 hours from the U.S., it seems that there's just a lot of noise and fear that people have. And I was wondering if you could maybe talk a little bit about people being afraid to do anything, and so they stay where they are. You know, being pushed to the edge with regards to the budgeting, and then everybody says, you know, there's a lot of noise engendered on people saying, you know, things are going to go catastrophic, and then we pull back from the edge, and we keep doing that often enough that it's like the boy who cried wolf, and that there's not much, you know, that the government really has major problems, and maybe they're not going to address them. I guess I'm afraid of that. I can see from Qatar here in the Middle East that they're cutting back on oil production. They're letting people go. There was 5,000 people who were gone, which may not be a big fraction in the U.S., but it's a big fraction of highly paid expats. And I guess I'm just nervous and concerned since we're planning on moving back next year.
Yes, well, I mean, I would be remiss or careless if I just, you know, if anybody really ignored all those concerns. And unfortunately, that is, I wouldn't lie to you, that's basically the way things work, is that's, you know, the election cycles are the election cycles, and that's, for the most part, things are looked at with a pretty short-term lens. Like I was saying, oh, you know, the markets are looking favorably. And again, admittedly, I'm speculating a little bit with this, but, you know, markets are looking positively at, keeping interest rates super low, taking on a lot of debt, spending a lot of money, borrowing into the future, things that probably don't make sense with a 20-year time frame, but there's very few folks running things that have a 20-year time frame, because that's not how it works.
Yeah.
On the other hand, it does seem like, I hope this doesn't sound Pollyanna-ish, but a lot of times things have a way of balancing out. So one of the things that's happened is that government has taken on a lot of debt over the past few years, for sure. But correspondingly to that, individuals have cut theirs. It's kind of been interesting. People have been paying off their mortgages, paying off their credit cards, really solidifying their own situation, even as the government was making theirs more risky. And it's kind of been interesting because that's happened some other times too, where, for instance, in the big housing bubble, individuals were taking on a ton of debt, and corporations and actually governments to some extent were managing theirs pretty carefully. So it's sort of been interesting. The overall indebtedness and some of the risk, I would say, hasn't really varied as much as might seem, just looking at some of the statistics. But I definitely wouldn't want to take away from what you're saying that this kind of short-term thinking is definitely a risk. And some of these, kind of manufactured crises that have happened within the U.S. over the past few years, like the debt default and budget showdowns and all of that, there's nothing positive to be said about those.
Thank you.
But again, I just kind of realized as I was saying that, again, it's kind of, then you kind of step back for a second and say, oh, but with all this going on, the economy has grown for almost 7 straight years, and the stock market has gone up, I wouldn't say in a straight line, but pretty close to one since about March of 2009. And it's pretty remarkable how resilient certainly the U.S. economy has been, and even the global economy really certainly hasn't had a downturn. It's had its blips along the way, but it's been pretty remarkable, kind of some of the things that have been shrugged off over the past 7 or 8 years. And I think, again, without trying to paint everything in a rosy light, that's a legitimate reason to be optimistic about, some of the challenges that we have ahead.
Thanks. So I guess we shouldn't worry about coming back. That's good.
No, come back and pay taxes. We need your help. Anyone else have any questions or thoughts, observations?
I do have another question, Nate, and that is, it says here that this session is being recorded. Are these available as a restricted sort of podcast to people who can't make the meetings?
Yes, in this case, yes. I think even the prior one, what we will try to do if it records correctly, is we're actually able to put it onto YouTube, and we will send out a link to that along, similar to how we did the invitation.
There will also be a link on our website.
Okay, and Joe here also reminds me that we will put a link on our own website that you could just click on it that way as well.
Okay, thank you.
Sure. All right. Well, like I said, we will follow up with everyone about the link to the recording. We'll keep it on the website for a while, and I just want to thank everyone, people throughout the country and throughout the world who were able to call in. Really appreciate it, and I'll talk to you all soon.
All right.
Thank you, Nate.
Thank you.
Have a great day. Bye.
Bye.